Ladies and gentlemen, good afternoon. First, I would like to thank George Athanasakos for inviting me as a keynote speaker to this value investing conference, and of course, thank my friend Jamie for his nice words. Actually, he was very kind with me because he missed to mention that maybe I'm a person that has delivered quite a level of bad news in the past for Fairfax, embarrassing news, I would say. But people at Fairfax still love me, so I'm really grateful about that. So, what has been the story? I mean, it was back in 2014, that was in the mid of the Greek financial crisis, that Fairfax participated in the capital increase of Eurobank at a price per share of 31 euros. At that point, the perception was that because the Greek economy was recovering, that this capital increase was enough for the bank to recover, to restore capital ratios and return into profitability. It was only 18 months later, in 2015, when I came back to Fairfax, because of the really ugly political developments of the first part of 2015. It was a time that Greece was almost out of the Eurozone, and we had capital controls in Greece, and Greek banks had to go through another capital round. However, for Eurobank this time, it was not at 31 euros per share. It was the capital increase at 1 euro per share. So you could really appreciate how happy people at Fairfax were hearing this news. But the rest is history. But let me start this story from the very beginning. And today I will spend some time reminding you some events about the Greek sovereign crisis and how this has affected the Greek banking system. I will talk about the various recapitalization rounds that the bank has gone through, how Eurobank presented and executed a holistic turnaround plan that was in late 2018, how 2023 has been a record year for Eurobank, and what is the outlook for 2024 and the three-year plan 2024 to 2026. And obviously, I would be more than happy to answer any of your questions. So, starting with a few points about how the Greek sovereign crisis that started in 2009 on the back of the global financial crisis has affected the banking system. We had more than 25% cumulative GDP loss. 50% of the deposits were lost, triggering an unprecedented liquidity crisis. The government bond PSI losses effectively erased the full capital of the banking sector. NPLs peaked around 50% of the loan books. Real estate prices dropped by 40%, and unemployment peaked close to 30%. So I think you would agree with me that that was a really perfect storm. Now, let's look at some graphs to visualize what I just said. You can see that between years 2009 to 2013, there was a massive loss of output, summing over to 26%. Unemployment reached a high of 27.8% in 2013. We had a straight line decrease of deposits amounting to 50% of the deposit balance in 2009. And that deposit outflow overseas or under the mattress triggered capital controls in the mid of 2015. Debt to GDP reached a level of 190% in the mid of crisis, to peak at 207 during the pandemic, and to decline after that. Debt accumulation was the result of massive negative primary balances between the years of 2008 to 2013. And NPLs peaked close to 50%. So this is what we have to go through, and part of that is also the experience of investors that joined the banking system 2014 onwards. So as a result of the situation, the Greek banks have to go through a massive consolidation. Out of the about 25 banks in the system, we ended up with 4 or 5 banks, and most of them have to go also, or actually all of them, had to go through a number of recapitalization cycles. The first one for Eurobank was in 2013, 5.8 billion euros. That was covered entirely by the state. Eurobank effectively was nationalized with HFSF, which was the state fund, owing 95.2% of the share capital of Eurobank. 2014, I mean, we already talked about it, another capital increase, 2.8 billion euros at a price of 31 euros per share. Here it says 0.31, it was 31 euros per share, but that was covered entirely by the private sector, diluting the state from 95% to 35.4%. Then we have the events of 2015. As I said, the country reached a point that was just one step before exiting the Eurozone. Capital controls were imposed, and all the banks have to go through another round of capital increase. 2 billion euros for Eurobank at the price of 1 euro per share. And again, that was covered entirely by the private sector, and the state was diluted further from 35% to 2.4%. However, despite the massive capital increases, the legacy issues for the banks were remaining. The most prominent of those was the huge stock of NPLs at the level of 50% of the books, and the progress was rather small. So it was late of 2018 when Eurobank was the first bank in the system to present a rather holistic plan to address all the legacy issues, to address 3 main points. One was to clean up the balance sheet. The second, to enhance the capital base. And the third, to restore profitability. Now, how was this done? In terms of cleaning up the balance sheet, a bold decision to massively sell the NPLs was taken. That was implying additional losses for the bank. So these losses had to be covered by fresh capital. And the tool of securitization, NPL securitization, was used. That was the case mainly in Italy. It was used quite successfully. And Eurobank was the first bank in Greece to use the same technology for the cleanup of the balance sheet. However, we needed more capital to do that. And this is where Grivalia step in. As Jamie mentioned before, Grivalia was a real estate company, a REIT listed in the Athens Stock Exchange. It was a spin-off of Eurobank. And at that point, in late 2018, Fairfax was 50% shareholder of Grivalia. So together with the CEO of Grivalia, George Chrysikos, who is with us today, we decided to move forward, merging the two companies, merging Eurobank with Grivalia. That was €1 billion injection for Eurobank. And at the same time, Fairfax was able to reach the current stake at Eurobank of 33%. The transaction took place at a price per share for Eurobank close to 40 cents. So we had the 2014 capital increase at 31 cents, the 2015 capital increase at €1, and the 2014 at 31 euros, not cents, the 2015 at €1, and the implied capital increase through the merger with Grivalia at 40 cents. And we had also a second transaction, the spin-off and the sale of our NPE servicer that was sold to an Italian company, doValue, for €300 million. And finally, the objective was to restore profitability and deliver over the next couple of years a sustainable double-digit return on equity. Now, that was the plan about the Greek business. However, Eurobank had also operations outside Greece. Back in 2014-15, we were present in countries like Southeastern Europe, Bulgaria, Cyprus, in Romania, in Serbia, in Ukraine, and also in Luxembourg. So there was a question of what to do in terms of our strategy for the operation outside Greece. And the first decision was that it would be best for the bank to retain some presence outside Greece, but for those countries in which we have decided to stay, to have a systemic presence, to have a market share of at least 15%. Banking is about size, and in my view, does not make any sense to be present in a market with small market share. So the strategy was to exit markets in which we had a suboptimal presence, and gradually we exited Ukraine, we exited Romania, more recently Serbia, and in the markets that we decided to stay, core markets like Bulgaria and Cyprus, we move forward with acquisitions, reaching a market share in Bulgaria of north of 15%, and with a recent acquisition in Cyprus, we're going to become the largest bank there through the acquisition of the second largest bank, which is called Hellenic Bank. We're going to talk more about it. So we are becoming the largest bank in Cyprus with a market share of about 40%. So in summary, we had a clear strategy about cleaning up the mess in Greece, dealing with the legacy issues, and also a strategy about operations outside Greece, exiting countries with suboptimal presence, and enhancing our presence in the core markets of Bulgaria and Cyprus. So let's see what the results of this plan was, because plans are nice, but execution is what really matters. So first objective, to clean up the balance sheet. On this graph, you can see the evolution of the NPE ratio over time between 2016 to 2023. Close to 42 percentage points of reduction in terms of NPEs was delivered, driving the ratio from 45% down to 3.5% in 2023. You can see the sharp drop between 2019 to 2020, from 29% to 14%. That was the time that we had the massive sale of NPLs. And you can see that in 2021, we reached the single-digit NPE ratio that we had committed to. We were the first bank to reach a single-digit NPE ratio. In absolute numbers, the NPEs dropped from about 23 billion euros down to 1.5 as of December 2023. And at the same time, the cash NP coverage increased from about 50% to more than 85% in 2023. Second objective was about enhancing the capital base. You see how the merger with Grivalia drove the CET1 ratio to 14.6%, which then dropped at 12. Capital was spent to finance the NP cleanup and subsequently to increase to the current level of 70% through the organic profitability of the bank, and total capital to reach a level of more than 20%. So in a few years, from a situation of capital shortage, we are now in a situation of excess capital. Most of the questions that I receive from analysts is how we can deploy the excess capital that the bank has. It's a nice problem to have, but still a problem. Third objective, to restore profitability. You see here the evolution of return on equity over time, reaching a double-digit, a close to double-digit return on equity in 2020, and having a return of 18% in last year, in 2023, a really exceptional year for which I'm going to speak more. And on the right part of the page, you see also the evolution of the earnings per share, reaching a level of more than 30 cents per share in 2023. I talked already about the non-Greek business. Out of this earnings per share, this, let's say, 34 cents earnings per share in 2023, 30% is coming from the banking business outside Greece. And this participation should increase from 30% close to 50% over the next few years by the end of 2026 because of the acquisitions that we have done both in Bulgaria as well as in Cyprus. So, summing up the achievements of the bank since 2018, the year that we presented the plan with Grivalia, Eurobank became the first Greek bank to reach a single-digit NP ratio, the first bank to have a double-digit return on equity. In 2023, we have been the first and only bank to reward shareholders for the first time after several years through a small share buyback of about 100 million euros. That was 1.4% of our share capital. And we used these funds to buy back entirely the stake of the state from Eurobank, so Eurobank to become the first bank without any participation of the state. And to be also the only bank with a material activity outside Greece. Now, this is the past. Let me focus a little bit more about the performance in 2023. 2023 has been an exceptional year for a number of reasons. We had a record profitability, organic profitability as a result of a plan that we had executed, I think, quite successfully, but also the monetary policy shift towards higher rates was another factor that has helped. Now, let's see a few graphs about the performance of the bank in 2023. Core operating profit. This is core PPI, excluding the volatile element of trading gains, minus cost of risk, minus provisions. Reached 1.5 billion euros in 2023, 70% increased versus 2022. The increase in net interest income was the main driver of this increase, but also fee and commission income grew quite nicely, both in Greece as well as outside Greece. Return on equity, as we have already seen, it reached 18%, up from 11.4% in 2022. And tangible book value per share increased to €2.07 from 1.71 in 2022. Actually, in the last 2 years, 2022 and 2023, the cumulative increase of tangible book value per share was close to 50%, 50. In terms of the balance sheet, the NPE ratio dropped from 5.2 to 3.5. Capital increased to 17%, up by 180 basis points. So, as a result of this turnaround story, and as a result of the exceptional performance of 2023, the bank will be able to return into cash dividends in 2024 of the financial results of 2023 for the first time since 2008. So we envisage a payout ratio of 25% plus of the financial results of 2023. This would be around 9 cents per share, or a dividend yield of circa 5%. And the objective is gradually to increase the payout ratio to 50% over the next 2 years by 2026 to reach a payout ratio of 50%, which is the European average for dividend and share buyback payments. So when in March we announced the full year results for 2023, as we do every year, we also provided some guidance for 2024, for the year to come, and also guidance for our 3-year plan, 2024 to 2026. In terms of the macro outlook, we are happy and we are lucky that we operate in a region in 3 core markets, Greece, Bulgaria and Cyprus. All 3 of them show growth quite higher than the European average. In 2023, the growth in Greece was 2%, 2.5% in Cyprus, 1.9% in Bulgaria, versus a growth for the Eurozone of 0+. And this is expected to be the trend for the next 2 to 4 years. So this is something obviously that we can take advantage. Our main objective for 2024 and the 3-year period is to keep delivering resilient returns in the area of 15%, despite the fact that in Europe we are entering a period of declining interest rates. In our business plan, we have assumed 3 rate cuts in 2024. It may be 3, it may be 4, and another 2 rate cuts in 2025. So the objective is to keep delivering return on equity of about 50% throughout the period, despite the fact that we are going to face lower interest rates. This is objective number 1. The second is to increase the contribution of our operations outside Greece from about 30% in 2023 to gradually close to 50% in 2026. And as I mentioned already, to increase the shareholder reward, the payout ratio towards the 50% mark by 2026. I mentioned already an important acquisition that we have done. This is the Hellenic Bank in Cyprus. This is the second largest bank in the island. Eurobank Cyprus is currently the 3rd largest bank. However, through the potential merger of the 2 entities, we're going to become the largest bank in Cyprus. In 2023, Hellenic Bank had a profit before tax of close to 400 million euros. This compares to the 1.5 billion euros of core operating profit for Eurobank. So you could appreciate that this is a meaningful acquisition. Hellenic Bank is a retail bank and fully complementary to the business model of Eurobank Cyprus, which is mainly a corporate bank. It has a strong balance sheet with loans of 6 billion euros and deposits of 15 billion euros, so there is plenty of room to further increase the loan book. Currently, we own 30% of this company. However, we have already signed agreements to increase the 30% to 55%. We are in the process of securing all the regulatory approvals. Therefore, by June, we should close this transaction and then launch a mandatory tender offer to increase further our stake. And we're going to consolidate, from an accounting point of view, Hellenic Bank as of the third quarter of 2024. So, where we stand in terms of projections for core operating profit, as I said, we want to maintain the same core operating profit despite the fact that NII is going to have a hit by the lower interest rates. Capital is going to remain quite robust, higher than 17% throughout the three-year period, despite the fact that we are increasing the payout ratio for our shareholders. And this is a summary of the key performance indicators for the bank in 2024. Return on equity of 15%, payout ratio this year more than 25%, tangible book value per share to increase from 207 to 2.30, CET1 ratio more than 17%, and NPE ratio less than 3.5%. So this is where we stand. Overall, we are really excited about the prospects of Eurobank. We have, I think, a strong track record. We have a really dedicated management team. The members of the management team work together for the last 15 years. We operate in a region with a strong macro backdrop, and I think we have a plan on how to deliver on a consistent way returns on equity of about 15%. So this is our turnaround story. Thank you very much for your attention. I would be more than happy to answer any of your questions.
Congratulations on an amazing turnaround. That's quite remarkable. And clearly it takes a brilliant CEO and a great plan and wonderful execution to make that all happen. I'm just wondering, from the perspective of a value investor like Fairfax coming in and participating with you and doing this turnaround, how does that work? Did they recruit you? Were you there before? What made it all work? Was there more capital or was there advice? What's the relationship like with a value investor?
Yeah. So I have been with Eurobank since 1997. Actually, I started my career in banking in 1991 with JP Morgan in New York City. By training, I'm an engineer, not an economist, not a banker. So I became a banker through this career. Then I moved to Citibank in Athens, and then since 1997, I have been with Eurobank in various positions. And this is how Prem met me. I mean, he met a number of executives of the bank back in 2013. And the rest of the story is what you have already heard. Now, definitely, part of the success has been having a dedicated, devoted shareholder so that the management and the staff can feel the security that the bank could move forward even during the difficult days. And I think my experience was really amazing with Fairfax after the embarrassment of 2014, Fairfax to follow the 2015 capital increase, to remain invested in very difficult times, and thank God it has been rewarded for this belief.
You have a kind of a curious core equity tier 1 ratio of 17%. Is that regulatory? Very high. Is that regulatory driven or is that cultural?
It is regulatory driven. Let me tell you how it works. There is the regulatory ratio that the ECB sets. Then we have an internal buffer, equity buffer, that brings the ratio at 14.5%. So ideally, the bank should operate with a CET1 ratio of about 14.5%. At the moment, we have this excess capital of 250 basis points. This is the reason why I said before we have excess capital, which is a problem, a nice problem to have, but still a problem. It would be nice if we could have the opportunity to deploy this capital, or otherwise we should be able gradually to return this capital back to the shareholders. So 14.5 is, let's say, the target CET1 at which we should operate in order to be able to maintain also attractive return on equity.
What is the regulator waiting for allowing you to announce it?
I think you could appreciate that the experience for the regulator was also quite traumatic, having to go through a mess in Greece for a number of years. Regulators tend to be on the conservative side and try to remain as defensive as possible. So Eurobank was the first bank to be able to have a shareholder reward in the form of a share buyback last year. This year we are returning into dividend payments with a rather modest payout ratio. Gradually we are going to increase that by 2026, and I think this would accelerate the return of capital to shareholders, both through the form of dividends but also through share buybacks.
What are the threats you see in the Greek economy and how this will affect you?
Okay, this is a question that I receive quite often, and I would say that for a country that has exited a long period of crisis, the imbalances that may exist are rather small or non-existent. So I would say that for the foreseeable future, for the next 2 to 4 years, I cannot really see any material internal threats coming within the economy. On top of that, we have maybe the most stable government in Europe. Elections took place in 2023 for a 4-year term. The previous government was re-elected, and we have at least 2 to 3 years more of stable political environment. We have a government which is quite pro-business, pro-growth, and therefore I would say that any sort of threats are mainly external, either geopolitical, an event like Ukraine, energy crisis, or interest rates coming down much more aggressively than what the market expects.
Or don't go down at all, go up.
No, I think that in Europe they're going to come down, because the large European countries like Germany, France, have really a bad economic performance. Germany was last year at a mild negative growth environment. in a mild recession. This year is going to be around 0%, so I think it is inevitable that by June the ECB will start cutting rates. The situation is different in the US than in Europe.
Any last question? Over there? Yeah.
Thank you. Thank you for you and your team's hard work. Obviously, you've done an incredible job turning this thing around, so thank you for that. There have been a few big blow-ups in some real estate operators in Europe. Do you see that as the tip of the iceberg? Do you think there's more coming? Is your bank pretty isolated from that as well?
Yeah, that's another interesting point because most of us read about the concerns that exist with commercial real estate loans in the US, in Northern Europe, especially Germany. The situation is a point of concern for these markets. Now, Greece is in a different cycle at the moment, and why is this? When, during the last 10 years, there was supply of new construction in all the developed markets, in Greece, construction was zero because of the financial crisis. Therefore, we are in a situation that the prices are correcting from the lows of the previous decade. Still, prices are below the European average, and construction has just started. So until we have enough supply of either residential or commercial real estate in the market, I think Greece remains immune from any sort of real estate crisis.